If you're planning to buy an under-construction residential property, one decision can make a massive difference in how much tax you pay. When should you sell your existing house to fully claim Section 54 benefits? Because under Section 54 of the Income Tax Act, the timing of your sale determines whether you get a complete exemption on your long-term capital gains or end up paying a hefty tax. Let's break this down clearly. Section 54 gives you tax exemption when you sell one residential property and reinvest the long-term capital gains into another residential house. But there's one crucial condition that people often miss. If the new house is under construction, its construction must be completed within 3 years from the date you sell your existing property. This is the deciding factor for your tax exemption. Now here's the challenge. Under construction projects typically have completion dates that stretch far out, often 4 to 5 years from today. If you sell your old house now and the project completes after 3 years, you automatically lose your Section 54 exemption. That means your capital gains become fully taxable. Some people hope they can claim that the delay was outside their control, but this only works when the project was supposed to finish within 3 years and later got delayed unexpectedly. If you already know at the time of booking that the project will take more than 3 years, the delay argument does not hold up. So what's the smart move? To avoid litigation and ensure full tax exemption, you should time the sale of your existing property so that your project's completion date comfortably falls within the 3-year Section 54 window, as per market experts. This usually means selling the existing property closer to the possession date, not right at the beginning of the project. In most real estate timelines, selling 2 to 2.5 years after booking tends to align well with the law. Now, let's talk about reinvestment. Since indexation benefits for property capital gains have been removed, Section 54 requires you to reinvest only the plain long-term capital gains into the new property. This is usually far lower than the property's market value. And here's an important insight. You do not need to reinvest the exact same money you received from the sale. You only need to ensure that the cost of the new property equals or exceeds the capital gains amount. Even if your funds come from a home loan or savings, the exemption is still valid. Now, about home loans. How much loan you should take depends on 3 things. Will the new house be self-occupied or rented? Are you in the old tax regime or the new tax regime? Do you want to maintain liquidity or reduce loan cost? Home loans today are still cheaper than most other forms of borrowing. So keeping some cash aside for emergencies, instead of putting everything into the property, is often a wiser choice. If your investments can earn more than your home loan interest rate, then taking a higher home loan can actually be financially beneficial. So here's the complete picture. Sell your existing property only when the under construction project will finish within 3 years of the sale. Selling too early. No Section 54 exemption. You only need to reinvest long-term capital gains. The exemption applies even if you reinvest through a home loan. Choose loan amount based on cash flow, tax regime, and investment strategy. This timing strategy alone can save you lakhs in taxes and help you optimize both construction timelines and financial planning.